If you own property, invest in property, or dream of stepping onto the property ladder this year, here's what you need to know for 2025. And in case you're wondering why the hell you should listen to me, well, I've spent since 2013 building a UK-wide home buying company, British Home Buyers, a nationwide estate agency, British Home Sellers, that has dealt with over 13,000 transactions, totaling about £3.3 billion of property. And take it from me, this year is a big year ahead. We have not just seen nominal house prices increasing again, but real house prices adjusted for inflation beginning to hit the positive. We have 2 and 5 year mortgage rates trending downwards. And even better, most expect the Bank of England to cut rates multiple times through this year. But, and this is a big but, we have the Renters' Rights Bill working its way through the House of Commons at the moment. Something most property investors have been scared stiff about since Labour came into power. And of course, this has already triggered a record number of buy-to-let properties being sold. 18% of properties on the market right now are former rentals. On top of this, we have Keir Starmer desperately unpopular across the UK, and the Labour Party in general not doing any better. But of course, this man is pleased with himself, with a recent poll putting Reform UK ahead of Labour for the first time. So, now that is quite an intro I've been through there, and I hope it illustrates just how important I think this video is in walking you through the top 10 things that could change the property market forever this year in 2025. In no particular order, change 1, President Donald Trump. Think for a moment that the US is our largest export market. It's 21.7% of all our exports. We export £187 billion to the US, but the US isn't our biggest import market. The EU is. It accounts for 51% of our imports. With the US, we import about £115 billion, about 17% of our imports. A £72 billion deficit to the US. And we all know how President Trump feels about his trade deficits at the moment. So look, if Trump likes us, there may be no issue with this gigantic trade deficit that they have with us. But think about what's happening with Canada at the moment, with Trump signalling he's going to put 25% tariffs on goods coming into the US from Canada and Mexico. In short, if there is one thing about President Trump we shouldn't take for granted, it is just how unpredictable he is. And the US is such a giant economy that you just can't overlook its effect on the UK economy and therefore house prices. Change 2, no-fault evictions. This is one of the major changes to be proposed in the Writers' Rents Bill. The abolishing of Section 21, no-fault evictions, will mean landlords will no longer be able to evict tenants without a legitimate reason. There will also be no such thing as fixed term tenancies, as when these changes come into effect, all tenancies will automatically convert to rolling contracts that could only be ended with a valid reason. So this has left many landlords worried as to how easy it will be to ask a tenant to leave and regain control of their property, as you won't be able to ask for your property back unless a tenancy has been running for at least 1 whole year. And if you do that, you need to give 4 months notice, which is up from 2 months notice at the moment. Also, if you want your property back because a tenant isn't paying rent, you'll now need to take your tenant to court to prove they haven't paid their rent. And the only circumstance a judge will ask a tenant to leave is if they are in serious rent arrears, which is defined as being in 3 months rent arrears, up from what is currently 2 months of rent arrears. And once they are in 3 months rent arrears, only at that stage can you give them 4 weeks notice to leave the property, up from what has previously been 2 weeks notice. So look, this is massive because at some point, you won't be able to just serve a tenant Section 21 for no reason at all, even if they're just a day late paying rent. When this comes through, if a tenant isn't paying rent, the quickest a tenant will vacate, if they respect a court order, will be at least 4 months. And that doesn't take into account delays added by the courts, or if the tenant ignores the court order, in which case it can take even more time and expense to escalate the process for a bailiff to enforce the eviction. In conclusion, this is a big concern for landlords. Change 3, rent increases. Another major change to be proposed in the Renters' Rights Bill is you won't be able to write in rent increases into your tenancy agreements. Instead, a maximum of once a year, you can declare to your tenant that you plan to increase the rent. And of course, you can only increase the rent to whatever the fair market rent is defined as at the time, which seems fair enough. But at this stage, if the tenant disagrees, they can reject it and refer it to a tribunal. So of course, a concern is that why wouldn't you as a tenant reject any rent increase? Because ultimately, worst case, it delays a rent increase whilst a tribunal looks and assesses whether that rent increase is fair or not, by which time more cost and time is lost for the landlord. The next big change is change 4, stamp duty. The zero rate threshold will drop in April from 250 grand to 125 grand. And for first time buyers, the threshold is dropping from 425 grand to 300,000. The reason this is important is whenever we see these sorts of upcoming changes to stamp duty, you get a flurry of activity as people race to buy and complete pre-April. So this table shows monthly transaction volumes and how changes to stamp duty have always created massive spikes in activity just before, with drops after, as you can see. So we're likely to have a very busy Q1 with a slowdown Q2 and then a pickup again thereafter. The next big change is change 5, bidding wars. So this is an odd one that's been proposed in the Renters' Rights Bill as well. So for example, if you're advertising a property for rent for, let's say, £1,000 a month, the new changes will mean you can't accept any rental offers above the advertised monthly rent of £1,000 per month. So if someone offers you £1,200 a month, you can't accept it. The idea is it stops auction-like bidding wars between tenants driving the price up. So in reality, all the market will really do to adjust to this is set higher marketing rents and edge them down rather than set lower rents to attract loads of tenants to bid back and forth and edge it up. I mean, I'm personally not sure how this fixes anything. Let me know in the comments if I'm missing something here. It just seems like a silly rule to me that people are just going to get around. Anyway, change 6, holiday lets. So there are quite big changes coming into the holiday let sector. These changes aim to align the tax treatment of short-term holiday lets with that of standard residential property rentals. I'll go through each of the 5 key changes one by one just so they're clear. One is mortgage interest relief. So the current situation is owners that own holiday lets in their own names can fully deduct mortgage interest payments from their rental income. So in effect, they're bypassing Section 24. So of course, if you already own a holiday let within a limited company, this will make no difference to you. But of course, when Section 24 was brought in 2015 and phased in fully in 2017, you had a growing number of landlords that simply switched their buy-to-lets into holiday lets to bypass those tax issues. Those people won't be able to do that anymore. So post-April 2025, mortgage interest relief will be restricted to the basic rate of income tax, so 20%, similar to the rules for standard buy-to-let properties. This means higher rate taxpayers will receive less relief, ultimately kind of potentially increasing their tax liability. The second big thing is around capital allowances. So the current situation is owners can claim capital allowance on the cost of furniture, fixtures and fittings. Basically, you can deduct all those things as a pre-tax cost. Post-April 2025, the ability to claim capital allowances will be completely removed. Instead, owners may only deduct the cost of replacing domestic items like, washing machine, for instance, which is exactly the setup for traditional buy-to-lets at the moment. The next key thing is capital gains tax reliefs. So The current situation is that holiday let properties qualify for certain capital gains tax reliefs, including business asset disposal relief, which was formerly the entrepreneur's relief, which can basically reduce the capital gains tax rate to as low as 10% on qualifying gains. Now, post-April 2025, eligibility for these reliefs will stop. Gains from the disposal of holiday let properties will be taxed at standard capital gains tax rates, which would be applicable to any residential properties you'd sell, which I know will annoy people with holiday lets that might have been counting on that tax break. But the fact holiday lets had access to this relief was more of a loophole that's now being closed than a fair benefit. The next is pension contributions. So again, the current situation is profits from holiday lets are considered relevant earnings for pension contribution purchases. So it allows, owners to make tax advantaged pension contributions. Post April 2025, holiday let profits will no longer count as relevant earnings, potentially limiting the amount owners can contribute to pensions with tax relief. And finally, loss relief. So the current situation is losses from holiday let businesses can only be offset against future profit from that same holiday let business, whereas post April 2025, losses can be set off against any other property income, providing more sort of flexibility in offsetting losses from one property investments to another. So those 5 things will come in April 2025. Now, the next big change is change 7, discrimination. So this is another proposal in the Renters' Rights Bill, which will mean that landlords won't be able to discriminate against who they market their property towards. So, for instance, they won't be able to discriminate against renters on benefits, for instance, or those that have children or pets. The potential complication with this is some mortgage and insurance products actually restrict landlords from renting to tenants on benefits, for instance. However, this same law that will be brought in will make those restrictions unenforceable, so it sort of avoids the issue. In principle, of course, this whole thing makes sense. The difficulty is statistically, certain tenants are going to be higher risk than others to landlords. In the same way, certain drivers are higher risk to car insurers. I guess, in theory, like with car insurers no longer being able to apply gender to assess risk, I suspect the market will just adapt in the same sort of way. Practically, for me as a landlord, I can still pick whoever I rent to. I just can't display on the marketing material no children or no one with benefits and so on. And of course, through the lettings process, I can't restrict anyone from applying or viewing the property or even offering on it. But I can still choose what offers and accept whatever offer I want. The next change is change 8, EPC ratings, changing by 20 to 30. Every buy-to-let property will need to have a rating of C or better as part of the government's Warm Homes Plan by 2030. Now, this could change. The Conservative government scrapped their plan to do a very similar thing. But let's assume this does happen. What's the problem with it? Well, the potential problem is right now, 80% of landlord properties are currently rated as D or lower. Then you add the fact that on average to improve the EPC rating of a property from D to C costs around £9,260. Change 9, the new Landlord Database. The final proposal I'm going to run through from the Renters' Rights Bill is this new Landlord Database that's being suggested. So I imagine this is going to operate a little like the current land registry for property ownership. If I want, I can type any address in the UK into it and download the title that will tell me who owns the property, if there are any charges against it, so mortgages and so on. This new landlord database, I imagine, will operate much the same. So you'll be able to search for properties rented, who the landlord is, who the letting agent is, and so on. At the moment, the details aren't clear as to exactly how this is actually going to work in practice. Who's paying for this? There's a lot of detail yet to be finalised with a lot of the aspects of the Renters' Rights Bill. And finally, the next change might not come to anything, but you just never know in today's world. Change 10, Nigel Farage's Reform UK. Now, I know this feels like an outside chance to many people at the moment, but when you consider that at a time it seemed so unlikely Donald Trump would get into office for a second term. I mean, he made the biggest political comeback in US history. So is it possible Nigel Farage could become our next Prime Minister? And if he did, what would that actually mean for UK property? Well, let's follow some breadcrumbs on this to try and figure what that could look like. The first thing to consider is Farage has amassed a £3 million property portfolio since Brexit. The next thing is Reform's chairman, Richard Tice, runs a property investment firm that manages assets worth about £500 million. And of course, Nick Candy, the billionaire property developer, is Reform UK's treasurer, and he's pledging to raise more money for Reform UK than any other political party in the UK has ever done in history. So do we believe he'll pull this off? Well, they are chatting with Elon Musk. So clearly they are assembling a real bid to taking Parliament, and the main players do have significant interests in property investing. So it's likely they'll want to protect those interests if they ever came into power. What do you think to all of this? Please like and subscribe. How likely do you think Nigel Farage will become the next Prime Minister? I'll see you in the next video up here.